Welcome back to this Macro 12 Explainer, where we're unpacking the absolute most critical global macroeconomic developments from the first week of August 2026. Now, this was a truly historic week, mostly because bad news surprisingly became very good news for the markets. From a deeply jarring U.S. labor print to intense global currency interventions and an AI revolution running headfirst into hard physical reality, well, we've got a lot of ground to cover.
Okay, let's take a quick look at the agenda. We're going to dive right into the jobs report paradox, then explore AI CapEx and monetization, look at the physical AI copper bottleneck, analyze the global FX and energy shocks, and finally bring it all together in our weekly macro recap.
So let's jump right into Section 1, the jobs report paradox.
U.S. employers unexpectedly cut 23,000 jobs in July. Yeah, you heard that right, a contraction. This landed as the second worst print of the entire year, falling behind only February, and it sent absolute shockwaves through the market. When this number hit the wires, it forced an immediate and drastic repricing of macro expectations across the board.
To really put this disconnect into perspective, analysts were widely expecting a gain of 80,000 jobs. Even the most pessimistic estimate in the survey was calling for plus 40,000. So this contraction was a historic, massive miss. And the immediate fallout? For investors, this meant a massive shift, as the market rapidly slashed the odds of a September Fed rate hike to well below 40%.
When we peel back the layers and look at the sector breakdown, you can see exactly where the bleeding happened. We saw heavy losses in local government education, dropping by 50,000. And leisure and hospitality shedding 40,000 jobs, along with retail dropping 19,000. Those steep declines completely overshadowed the modest but very real gains we saw in construction, which added 22,000, and manufacturing adding 5,000.
But here is where the data gets incredibly bizarre. Despite that massive headline job loss, the unemployment rate actually fell from 4.2% down to 4.1%. How does that even happen? Well, it's because labor force participation dropped to 61.4%. People simply stopped actively looking for work. On top of that, wage growth slowed to 3.2% year over year, which is the lightest reading of the year. This super strange cocktail, a contracting labor market effectively easing inflation fears, sent the two-year Treasury yield plunging to 4.17%, and ironically, it ignited the best week for equities since April, simply because rate hike fears just evaporated.
Which leads us perfectly into Section 2. AI, CapEx, and monetization.
BlackRock's CIO of Global Fixed Income, Rick Reeder, perfectly captures this structural shift. Looking at that bizarre jobs data, he pointed out that AI is driving a literal productivity revolution. It is structurally changing how companies hire and operate, allowing them to do a whole lot more with far fewer employees. And for businesses, that is a massive margin expansion opportunity.
But here's the catch. This productivity revolution requires historic amounts of capital. The numbers we saw just this week are staggering. Google issued $25 billion in new bonds, which the market aggressively oversubscribed to $115 billion. Over in China, DeepSeek is seeking $8 billion to build a massive 1-gigawatt data center in Inner Mongolia. Meanwhile, Amazon hit a historic $3 trillion market cap, citing sub-3-year CapEx payback periods, and SoundHound posted record revenues of $62 million, driven entirely by enterprise AI adoption.
But this whole capital arms race is causing some intense internal strain. Just look at Alphabet. Google Cloud and their AI research lab DeepMind are actively competing for the exact same highly scarce computing resource, TPU capacity. CEO Sundar Pichai has stated that DeepMind comes first. But with cloud committing infrastructure to external clients, the friction is incredibly real. Alphabet has actually flipped free cash flow negative as they pursue this all-in capital expenditure strategy.
Tying this directly back to our first theme on the jobs report, we have to recognize that AI isn't just some software upgrade. It's actively disrupting the labor market right now. Data from Revelio Labs reveals it now takes 5 job postings to produce 1 hire. That's up from just 2 before ChatGPT launched. Why? Because AI tools are automating the application process and completely flooding employers with resumes. Furthermore, AI-exposed jobs, particularly junior-level knowledge workers, are seeing postings drop by around 43%. The labor market is fundamentally transforming underneath our feet.
Transitioning from the software narrative over to physical reality, we arrive at Section 3, the physical AI copper bottleneck.
The cloud doesn't live in the sky, right? It lives on the ground, and it requires metal.
You simply cannot build gigawatt data centers without copper for wiring, cooling, and electrical systems. That massive explosion in infrastructure demand has driven copper prices up a staggering 50% year-to-date, vastly outperforming historical averages. Practically overnight, AI has become a commodity story.
As S&P Global's Vice Chair Dan Yergin pointed out this week, this massive wave of demand is violently colliding with an incredibly rigid supply constraint. For some context here, there are only 2 operating smelters left in the entire United States right now. Demand for AI, alongside defense and EV adoption, is soaring, but the supply side is completely gridlocked.
The timeline of a standard copper mine reveals the true friction here. You cannot instantly spin up a copper mine the way you provision a new server in the cloud. It takes an average of 17 years to bring new supply into production, from discovery through 5 years of permitting, all the way to the first mined metal. This hard, physical limit creates a structural price floor that could reinforce the very inflation narratives that are currently complicating Federal Reserve policy.
Moving beyond physical commodities, we turn to Section 4, Global FX and Energy Shocks.
Because while U.S. markets rallied this week, international bond markets were flashing some serious warning signs. This week, U.S. Treasury Secretary Scott Bessent and Japanese authorities were forced into a rare coordinated currency intervention. The Japanese yen had absolutely crashed to a 40-year low near 164 against the dollar. They had to execute this joint defense, utilizing euro-denominated trades and Federal Reserve borrowing facilities to avoid a global bond market liquidation. Think about it. If Japan had to dump their U.S. treasuries to raise dollars, it would have sent global borrowing costs skyrocketing.
But as Bloomberg Opinion's Jonathan noted, this intervention is really merely a temporary patch. He called it a chewing gum fix. The fundamental root cause hasn't changed at all. There is still a massive interest rate differential between the U.S. and Japan. Until the Bank of Japan executes meaningful rate hikes and establishes fiscal discipline, the yen remains structurally vulnerable to these massive sell-offs.
Simultaneously, we are seeing exogenous geopolitical shocks completely override normal seasonal trends. Reports of Iranian strikes on targets in the Strait of Hormuz raise some very serious questions about shipping lane access. This supply fear immediately pushed Brent crude above $82 a barrel. And elevated energy prices maintain a persistent inflationary headwind on energy-importing economies, which further complicates central bank policies across the globe.
Okay, let's bring all these complex threads together for Section 5, our weekly macro recap and takeaways.
This summary matrix, pulled directly from our Macro 12 briefings, perfectly illustrates the overarching narrative of the week. In fixed income, a shifting labor market is crushing rate hike fears, with September cut odds at around 65%. This cheaper capital is fueling a historic enterprise AI boom. We saw core capital goods orders up 1.2% as capital violently shifts to cloud hyperscalers. But that digital boom is now colliding with hard physical realities, like copper shortages and geopolitical energy shocks in the Strait of Hormuz overriding normal energy cycles. It is a highly interconnected machine right now.
Which leaves us with this final, vital question to consider. As AI growth accelerates and demands gigawatts of power and millions of tons of copper, how long can this capital-intensive tech rally sustain itself before crashing into the hard physical limits of global commodity supply? We'd love to hear your take. Drop your thoughts in the comments below. Thank you so much for joining this deep dive Macro 12 explainer, and I will see you all next week.